Hello and welcome to the Weekend Investing Daily Bite of 26th of September. And yet another day of markets making a new high, and you get bored of seeing new highs every day. That is the problem of bull markets. And it's a good problem to have. No worries on that. There is a divergence in the market now. Large caps are moving up, small caps and mid caps are not moving up. So we'll talk about that. And also, we'll talk about how Indian markets boom can last for a long time, given the macros that we have here. In terms of the markets today, you can see that Nifty has been here today, also rising 0.81%. We are now crossed 26,200. Just a few weeks back, 25,000 seemed to be a Herculean task, but now we are engaging at 26,200. Nifty Next 50 also closing at a new high, 0.7% up at 77,000, up almost three quarters of a percent. And this also is looking good. Mid caps is where some sluggishness was there yesterday also, and the same continued today as well, but not much damage done. By the end of the day, mid caps had recovered all the lost ground. Small caps, however, were down by 0.45%, also not too much. But yes, small caps haven't moved since the beginning of the first week of September. In terms of the bank nifty, this is where the major action has been since the Fed rate cut, and another half a percent on bank nifty now at 54,300. So bank nifty is now leading the rally, and there is a sector rotation that is happening on each week, I would say, if not every other day. Advanced decline ratio very even, 265 to 230 on the top 500 stocks. FIIs have resumed selling in the last two sessions, and DIIs have increased their buying in the last two sessions. So net institutional buying is still positive. In terms of heat maps, you can see the major focus is on autos today. So Maruti, Tata Motors, Bajaj Auto, Mahindra all doing well, FMCG doing well, cement and steel doing well. So some of these sectors have really picked up after a sluggish start. In terms of the Nifty Next 50, also you can see Motherson, Trent, Vedanta, Indigo, PNB, Canara Bank, all these guys doing well. And some give up on Havells, DMart, VBL, Siemens, and Geofinance. In the sectoral, you can see autos and metals have turned around this week. This week, these are the two leading segments, 2.3 on autos, 2.1% on metals. And for the last 3 months, they have been sluggish, but now they're catching on. Consumption stocks also up 1.2%, commodities up 1%. PSU banks today rallying after some time at 1%, FMCG also up 1%. So it was a very unique kind of a session where not only the defensives were rallying, but even the risk on trade was rallying. Only yesterday, where real estate had jumped up hugely, was flat today, and energy also was flattish today at 0.2%. Public sector enterprise surely have lost some sheen. You can see that in the last 1 month, public sector enterprise stocks have gotten just 3.6%. Energy has also lost the sheen here. IT is also slow, as well as PSU banks are leading the downward move versus the rest of the pack. Autos, you can see all these auto stocks, Maruti, Motherson, Apollo, Tata Motors doing well. Auto index is itself making a new fantastic high, a breakout kind of a move today. And in the stock spotlight, you can see Easy Trip Planners tried to regain 7%. There was a huge cut yesterday after the promoters sold off a significant chunk of their holding, and that too not near the highs of the stocks. That does not give too much confidence going forward. But if you see, there was a breakdown that happened on this move now at the breakdown point. So if we turn around from here, it could be a good support point, and the big chunk of the promoter equity is also now in the market. Will India's market boom last? So if we see the quarterly GDP growth trend in the last 7 8 years, the slowdown that we were seeing in 2018-19 leading to COVID, that part, if you take out, we've been reasonably stable at near between 7 and 7.5, or you can say 7.8 also, the 4 quarter moving average of GDP. So this is, it is not like the situation that you had in 2017 to 20, where it was declining downwards. And then, of course, there was a crack. Here it is very flat and it is chugging along well. So there don't seem to be too much of headwinds right here. In terms of the projections, also, you can see the 4 quarters out projections are quite good. In fact, FY26 also the RBI GDP projection is 7 plus. So if we are able to maintain 7 plus, then we are beating most of the world, and that itself is a thing that can continue to have liquidity flow towards our market. There was a phase where, if you see the last 40, 50-year chart in 1980 to 2000, that US markets really dominated, versus India markets. Although India market had the Arshad Mehta period also during that phase. But you can see that in this 2 decades, US markets went up 1400%, while India managed 500%. Now, in the last 2 decades, India market has really dominated, and this is in dollar terms. I'm measuring Sensex in dollar terms and comparing it to the US markets. So, if you are having this thought that US markets always do better than India markets, please see these statistics, and it will satisfy you that India market is a great place to be at right now. Of course, that can change over time, and if we are going to sustain this path of the trajectory that we've been on the last 20 25 years, I see no reason why India market investing will have any weakness going forward. The path to all these stronger and longer trajectories is always full of, you can say, pitfalls, and that is true for any market. In the last year also, we have seen that 2 times now, market has come very near to 200 DMA, and this has become the major support of the market each time. So anytime if the market cracks towards 200 DMA, I think that will be a very high confidence, high probability point to really add a lot of money there. Of course, it can always break down from 200 DMA, and it take its own sweet time to come back up. But from a probability perspective, this is a great place where the market should be bought. The markets are certainly overbought to some extent. They are certainly stretched, but as they say, markets can remain irrational for a very long period of time. And you would have noticed in the last 1 month also, a lot of great analysts, great gurus of the market who are sitting on cash, or who are saying that it's time to go to cash, are now in a fix because they are holding big cash in their portfolios. Market is continuing to run up and their performance is slipping. So never try to, double guess the market unless you are really good at that, and which 99.9% people are not. And that is probably the reason why most portfolios will lag, because people will have their own, psychological sort of overhang on the decision making. And if you are feeling scared, does not mean that the market will stop and fall down tomorrow. That correlation is really bad. I mean, you could be feeling scared because of whatever reason, but the market may be feeling very strong going forward. So, equating your own feeling versus the general market, that is the biggest mistake a lot of investors will make. Uh, of course, the next 10 years are likely to be the golden years of the Indian market, unless there is any political upheaval on the way. We are creating fantastic demographic change. A lot of new workforce, young workforce is coming into play. You can see the number of demat accounts going up. You can see the spending, the consumption around us. It is just amazing how the India story is catching on. But of course, do always have a asset allocated approach towards the market. Nothing is guaranteed, nothing is certain. All these calculations and calculators that 15% CAGR for next 30 years will go to the dustbin if some black swan event happens. So have calculated risks, have plan B in your life, have other investments also, and I'm sure at the end of it, you'll make some decent money. Thank you so much for watching, and I'll see you in the next one. Bye.